Bang! Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly record unearned revenues. So if you're unfamiliar with unearned revenues, don't fret gang, I dropped a link to a video that'll get you up to speed in no time. So with that being said, let's get it. So before we dive deep into this problem, let's quickly review what are unearned revenues. Unearned revenues are created anytime a company receives cash for a service to be provided in the future. Because that service to be provided in the future will generate revenues, those revenues will be recorded when they're earned. Since the cash was received upfront before the services have been provided, this is not considered an opportunity to record revenues. Unearned revenues aren't revenues, gang. They are liabilities. Why? Because the cash was received for the service in the future, thus creating a liability because the company still owes the service. So initially, an unearned revenue must be recorded as a liability. However, as time goes on and the services are being provided, thus generating the revenues, it is now time for the proper recording of those revenues. However, as those revenues are being recorded, the actual liability must also go down, thus adjusting the unearned revenue to decrease. So in terms of adjusted entries for unearned revenues, we must always decrease the liability while we are increasing the actual revenue being earned. So let's get into it. It tells us online gaming collects cash from customers in advance, then provides online games to subscribers over a 1-year period. So what's going on with this game? These online guys receive the cash up front, then provide the services throughout a year's time. Okay? So it tells us to record the journal entry of the original receipt of the $180,000 cash amount. Whatever the date is, we just received cash of $180,000 for a year's worth time of services to be provided in the future. So we have to record a liability because we haven't earned any revenue yet, thus creating an unearned revenue. So how are we going to make this initial transaction? We're going to debit cash for the 180 and credit a liability called unearned subscription revenue for the $180,000. So in terms of our explanation, we are simply recording cash for unearned subscription revenue. We're going to check the answer. Well done, gang. Requirement 2 tells us to record the adjusted entry that online gaming makes to record the earning of $8,000 subscription revenue that was collected in advance. Okay, gang. So obviously time has passed, and we know that because they have now earned $8,000 of subscription revenue. So since they've properly earned the $8,000 of subscription revenue must be recorded. But what else has happened throughout this time period? Since revenue has been earned, that initial liability, that initial unearned subscription revenue that was recorded must decrease by the $8,000. So this particular adjustment entry for our unearned revenue requires us to decrease our liability by debiting unearned subscription revenue and crediting the actual revenue that was earned, the subscription revenue that was earned for the $8,000. And so in terms of a proper explanation for this game, it's going to tell us to record earned revenue that was collected in advance. So we're going to check the answer. Bags all day. So there you have it, gang. A quick, easy illustration of how to properly initially record and adjust unearned revenues. So if that light bulb is clicking, gang, and you're further closer to chasing the bag with this accounting information, don't be stingy. Like, subscribe, and share the channel with your people so they can chase the bags as well. As always, gang, I'm Dr. Who, and it's a humble experience to have you spend your precious time with me, and I'll see you soon. Bags!